my estimate was we'd go to 150. If you just look at the pure cycles, it says 170. Some would say we're going to get to 200. I know Max is saying 220 and others. I'm taking 150. Maybe it's 170, but somewhere between 150 and 170 to me is where we end up in Q3. And then we start crypto winter again. So that's the longest answer you've ever had to a simple question. Bitcoin network, the network itself, the secured network Bitcoin's never been hacked, not once. Ethereum hacked, Bitcoin never been hacked. And it's had like 20 minutes of downtime in 16 years. So it's pretty reliable. Well, why? It's the most powerful computing network the world has ever seen. It's 1,500 times, not 1,500%, 1,500 times more powerful than CERN supercomputer. So,
according to Mark Yusko, Bitcoin is expected to hit $150,000 to $170,000 during this cycle. Some analysts even anticipate that it may reach $200,000 or higher. He does point out, though, that the lack of excessive leverage, which was previously supported by platforms like as FTX, may slow down the rate of price acceleration. Yusko, however, is still optimistic about Bitcoin's 4-year cycle and anticipates a peak in Q3 2025 before a further market correction. For long-term investors, Yusko emphasizes the importance of a well-diversified portfolio focused on equity, extending beyond traditional stocks to include private equity, real estate, and commodities. He sees Bitcoin as a crucial component, recommending a 5 to 10% allocation, with younger investors taking on a higher percentage due to their ability to handle volatility. His basic principle is ownership, giving assets with significant long-term growth potential precedence over fixed-income investments. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you, and enjoy the video.
So I will argue that you got two things going on. One, you got this natural arbitrage that's going on between people who are long the ETF, the financialized version of Bitcoin, and short the future. And that caps the price movement. Second thing that's going on is I do believe, and I don't know if it's Buffett, I don't think it's Buffett, but somebody has changed their mind. In my opinion, somebody, and whether that's nation states or whether that's other billionaires, somebody has changed their mind and they want to accumulate. And they don't want to accumulate at high prices, they want to accumulate at low prices. So what do? You unleash the bots on all the leveraged speculators. See, here's the problem. So here's my outlook for the year. So Bitcoin's fair value, as you said earlier, is around 95K, maybe 98, somewhere in the high 90s. What's that based on? That's based on Metcalfe's law, which is just a theoretical equation that takes all the inputs, the number of nodes, the number of transactions, etc., and comes up with a mathematical formula for the value of the network. And networks are valuable, right? 5 largest companies in the world aren't really companies, they're networks. Like, what is Amazon? They don't make stuff. They are just a network of buyers and sellers, and they take a cut. And their margins are really high. But the reality is that the Bitcoin network is very, very valuable. The Bitcoin network, the network itself, the secured network that's never had a fraudulent transaction. How many times do you have to get a new Visa number because your number gets hacked? Often. Bitcoin's never been hacked, not once. Ethereum hacked, Bitcoin never been hacked. And it's had like 20 minutes of downtime in 16 years, so it's pretty reliable. Well, why? It's the most powerful computing network the world has ever seen. It's 1,500 times, not 1,500%, 1,500 times more powerful than CERN supercomputer. So this is a really valuable asset, just as a computing asset. Well, then the number of nodes keeps growing, the hash rate keeps growing, all the fundamentals keep growing. So we can calculate this fair value. When the price is below fair value, who buys it? People like you and me and all the other people we traffic with, investors. We like to buy stuff on sale. We like to buy things below their fair value. That's what we do. Okay? And what does that do? That slowly pushes the price toward fair value. Now, as the price starts to move, who gets involved? Traders. Traders don't really care about fair value. They just want movement. They want to scalp a little here, there, up, down. They don't really care. They just want movement. Then who comes in? As we start to get towards fair value, and maybe we can get a little bit above fair value, well, then the speculators come in. Well, who's a speculator? Speculator is the opposite side of a hedger. So if the price is fair value and I'm a miner, okay, and I can produce it below fair value, then I will sell my production and I'll sell it forward in the futures market, and the speculator will come in and take the other side. Okay? That's just a natural phenomenon. It's like an oil producer or a gold producer. You sell forward production to lock in your profits to pay your bills, and somebody speculates. But then the problem is, as the price starts to move, it starts to generate attention, and there's this self-fulfilling prophecy. And then the gamblers come in. And the gamblers do a couple things. They don't give a shit. They don't care about value. They don't even know maybe what they're buying. They just see movement and they want in, and they use leverage. So that's what's happening in Bitcoin. Right now, you've got massive demand, right? You got BlackRock buying every day. You got Millennium buying. But here's the thing. Millennium isn't buying long. Millennium is a market neutral shop. I love when the 13Fs come out and everybody says, oh, look, Millennium bought $2 billion of the ETF. I'm like, yeah. And they shorted at least 2 billion, maybe 2.1 or 2.2 of futures against it, because they're just arbing the spread between the futures price and the spot price. There's something called roll yield, right? So the futures price is higher than spot price because humans are optimistic. And over the course of the month, that price rolls down. And that's why these futures-based ETFs destroy capital. They're really profitable for the people that structure them, but not if you hold them. It's like a triple levered, short ETF. They destroy capital because of the rebalancing and this roll yield between futures and spot. So we're in this thing where a year ago, the ETFs get approved and everyone's like, oh, it's going to be great. The price is going to go straight up. And we went up in anticipation. And then when it happened, because no one was talking, Anthony, about the same day, January 10th, the exact same day, not a coincidence, the CME listed massive numbers of new Bitcoin futures. So what's happening is every time someone is accumulating these big dogs, okay, the banksters can naked short against it to suppress the price. Now, part of that's just to make money, right? You're short here, you're long here, you make about 11, 12% annualized, and you lever it up 8, 10 times, and you make a lot of fucking money. Sorry.
Yusko describes the various kinds of market players that influence the price of Bitcoin during each cycle. At the bottom, value-conscious consumers and long-term investors acquire Bitcoin when it is cheap. Traders intervene as the price starts to rise in order to take advantage of transient fluctuations. Speculators who employ leverage to increase their profits come next. Eventually, unskilled gamblers who don't understand the basics of Bitcoin flood the market, pushing prices to unaffordable heights. Because of the fixed supply of Bitcoin and the predictable actions of market participants, this cycle keeps happening. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
And so what happens, we have this 4-year cycle. What's the 4-year cycle? Some of the most brilliant programming really ever, in the sense that every 4 years, the block rewards, the number of Bitcoin that are given to the miners to secure the network, which is a genius idea, it gets cut in half. But why is that a good idea? Well, think about it. All your miners have fixed costs. Electricity is fixed, the machines are fixed. So if you decrease the number of rewards in half, in theory, half of them should go out of business. But they don't. Why not? Because they're like, well, then I just won't sell. And I'll force the bid up in order for me to sell. So after the halving event, we see this basic doubling of fair value, okay? This doubling of price. Well, that increase attracts the speculators. So the halving event happens when we're below fair value because of the 4th cycle. So that first part of the cycle is that recovery from winter, and it starts to move toward fair value. Then we get into what's called crypto summer, which we're starting to get close to fair value, and the halving event occurs. That was a year ago. Then we get crypto fall. Well, what's crypto fall? That's where the price starts to move above fair value, and the gamblers come in. And the further it gets is based on leverage. In the previous 3 cycles, we got to just about 2 to 2.1 times fair value. So the first one, fair value was 10. I'm sorry, the first one, fair value was about 3,000. We got to like 6. Second, it was fair value was 10. We got to 20. The third was 32. We got to 69. So we get to these levels of extremes. Well, then gravity works, and somebody comes in, squeezes the people who are over levered, and the price starts to correct. Now, there are those who would argue that that's happening right now. The cycle's over and we're headed down. No, because we're too close to fair value. My guess, and I said this back in January, was the 4-year cycle extends sometime into Q3. Is it October? Is it September? I don't really know exactly, but that's based on long-term history. So in theory, based on previous cycles, we should get somewhere between 1 to 2 times fair value. If fair value, we'll round it to 100. I think there's going to be less leverage. We don't have FTX anymore. We don't have Bitfinex. There's not as much leverage in the system. There's still leverage. Obviously, we've seen that the last couple of days. But my estimate was we'd go to 150. If you just look at the pure cycles, it says 170. Some would say we're going to get to 200. I know Max is saying 220 and others. I'm taking 150, maybe it's 170, but somewhere between 150 and 170 to me is where we end up in Q3. And then we start crypto winter again. So that's the longest answer you've ever had to a simple question.
In closing, Mark Yusko emphasizes the significance of strategic asset allocation for long-term financial success, especially when considering multi-generational wealth. He emphasizes that the best strategy to maintain and increase wealth over time is to possess stock in commodities, real estate, or private companies. He promotes owning productive assets that can increase in value, as opposed to acting as a lender and depending on bonds, which have historically produced lower returns and are susceptible to inflation. His plan heavily relies on Bitcoin, which he feels should be included in every investor's portfolio. However, the exact amount will vary depending on the situation. According to him, younger investors in their 20s and 30s can afford to devote a significantly larger portion of their portfolio to Bitcoin because they have decades left to weather market turbulence and earn from long-term growth. On the other hand, older investors in their 60s and 70s who may value lower volatility and capital preservation might keep their exposure to Bitcoin to between 5 and 10%. He argues that, in spite of price swings, Bitcoin has a predictable 4-year cycle that has historically produced long-term growth. Yusko thinks investors may protect themselves against inflation, take advantage of financial and technological advancements, and preserve wealth for future generations by building a portfolio around equity-based assets and a suitable proportion of Bitcoin. His closing thoughts serve as a reminder that investing is about putting money into assets that have the potential to produce long-term value over many years, not merely about timing the market or making quick profits. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.